Hello, my name's Apricot Wilson and I work for Investing for Development, an impact investment firm based in Luxembourg with two sub-funds, the Luxembourg Microfinance and Development Fund and the Forestry and Climate Change Fund. Now, the Luxembourg Microfinance and Development Fund works very closely with ADA, and we're very grateful for them for having invited us along here today. We're the most capitalist institution in the Maison de la Microfinance, and it'll be interesting to give a perspective on what goes on in the impact investment world. So ADA has asked me to talk about impact investment, what it actually is, impact measurement, how we can measure impact, and about impact measurement within our funds, what we're actually doing on a day-to-day basis. And I do apologise, I hear a lot of listeners come from French and Spanish-speaking countries, and I do have a rather thick British accent. Now, but I think prior to getting stuck into the talk, it's useful for me to explain a bit about who I am and give you an idea of my background. I've now been in Luxembourg for 4 years, and if you haven't had the chance to visit this small city, it's really a great place and a fantastic place to work in impact investment. But prior to working here, I studied languages at university and completed some internships working in education policy. This gave me a broad idea of the development agenda and of how funding flows worked. But then after university, I followed most of my classmates down the road and went to work in London in a very large asset management firm. Now, in this large asset management firm, life was always pretty interesting. We spent our days analysing large companies, seeing their financial forecasts and their plans in the coming years. We would spend our time working out a veritable alphabet soup of acronyms. The return on equity, the return on assets, the internal rate of return, profit margins, operating margins, turnover. It was interesting to see how all these measurements were interrelated and how a company's plan could impact on those. But what was also clear to me was that the impact of lending a company money went far beyond the impact that could be calculated from the metrics we are looking at. In some cases, the additional investment we've made could lead to job creation, could lead to more people having access to education, could result in more energy being generated from renewable sources. In other cases, the impact we could have could be rather negative, such as increased carbon emissions or various forms of pollution, despite perhaps it being a financially attractive investment. I had unintentionally come across Ronald Cohen's theory of three-dimensional investment. Instead of the 2 dimensions that the ratios above tend to consider, there is an extra dimension that we should think of when making investment decisions, that of impact. Now, there are varieties of ways in which this can be considered when investing. At the most basic level, which is a practice that most firms are now starting to adopt, you can consider ESG, environmental, social and governance factors, whenever you make an investment, alongside all the financial considerations that you take into account. Now, what are these environmental, social and governance factors that you may consider? Well, these are, of course, fairly varied. Environmental factors may look at carbon emissions, pollution, deforestation, energy efficiency. Social factors include, among others, human rights and labour practices, but also gender and diversity and community relations. Governance looks at corporate governance issues, from board composition to the schemes and structures in place to protect employees, to, of course, the important question of compensation. These are all taken into consideration along with the financial data that I previously mentioned. Now, you could take a slightly stronger view, socially responsible investing, SRI, which can in some ways be viewed as a do-no-harm approach. Instead of purely analysing the ESG factors above, you decide that certain ethical concerns cannot be included in the fund. You may choose not to hold companies which derive portions of their income, for instance, from tobacco, or take a strong stance on fossil fuels. One step up from this is impact investment. This is where a positive focus on supporting projects which bring about a positive social or environmental impact. It moves away from a do-no-harm approach to actually focusing on bringing about positive change. It's worth looking at this definition in a bit more depth. The OECD provides one definition of impact investment. It says that investment provides finance to organisations addressing social and/or environmental needs with the explicit expectation of measurable social and financial returns. Now, there are several crucial elements of this definition. The explicit expectation of generating an impact. Impact investors are aiming to create an impact beyond the financial returns when they invest. The fact that they want to have a positive impact is not just incidental, as it was in my previous work in the financial industry. The expectation of financial returns, this is not philanthropy. Investors are providing you with money and hope at a very minimum to get it back, capital preservation. But many have rather higher expectations, but understand, as with all financial instruments, that this comes with a certain level of risk. And then the third point is measurable social impact. Now, this is where things become a bit trickier, and this is a point that I'll come back to. However, what's also interesting is that beyond these crucial elements, this definition leaves a lot of room for quite a lot of diversity and has very few restrictions. As an impact investor, you can invest in any form of instrument, from private debt to listed equities. And you can invest in anything from projects targeting the restoration of degraded forests, to healthcare, to student financing in developed countries, to projects supporting entrepreneurship in small island states. In fact, these were just a few examples of projects that I was discussing with people over the course of the past few days. So you can see it really is a very, very varied area. But going back to the original definition, the measurable impact is particularly important. How else do you know if you're really doing what you set out, what you intended to do, particularly when projects are so diverse? How can you compare the impact of a project supporting neonatal care, for instance, to a project supporting land use restoration? People are very aware of this challenge and accept that not all metrics will be the same. Nonetheless, the purpose of impact measurement becomes rather distorted if everyone measures things in a different way. To give a very simple example, which we often see, if you're measuring the amount of young people reached, it is useful if everyone is going to measure people from the same age range. Otherwise, it can become very difficult to know what you're comparing and what the impact of various projects is when they're put together. For this reason, a lot of initiatives have been set up to support impact measurement. You may have heard of a few of them. We've got the GIRS, IRIS, to name but a few. Yet, this still doesn't get to the crux of the matter. If you're measuring impact, what are you actually looking to measure? An easy approach that many people choose to look at is output, the direct result of the input of providing finance or technical assistance. This may be the number of trainings that have been delivered as a result of technical assistance, or the amount of homes that have been built as a direct result of receiving a loan. To look at this more granularity, you might consider outreach. Who these projects got to, whether they reach those most in need. Were the houses provided to the poorest communities? Was the training delivered to the young people from the most deprived backgrounds? Yet, this just provides you with the result of giving financing. It does not demonstrate the effect that the financing has had. To do this, you need to look at outcomes. The medium-term consequences of the project towards well-being. To use the previous example, did the young people who received the training go on to become employed or to set up businesses? And then, in the end, you can look at impact, the long-term consequences the investment has had, and not only on those directly financed, but also on the broader community or environment. These are often more subjective and harder to measure. How has well-being changed for people who were involved in the projects? How has the attitude towards training changed among those in the community? Are we noticing more people generally being enrolled into training programs? Now, I have not actually finished my previous career story. It may not surprise you to find out that, given what I've been saying earlier, that I actually went out to work in an impact investment fund. So you may be interested to know what we actually do within our fund. Now, we run 2 sub-funds. They're quite different. We run the Forestry and Climate Change Fund and the Microfinance Fund. Our Forestry Fund started its days with two intended outcomes. It aimed to sequester 11 million tonnes of carbon and to generate 3,000 jobs. This provides a fairly easy way to measure the achievements of the fund, at least in theory. We look to see how much carbon our projects are sequestering and how many new jobs our fund is generating. Among other frameworks, these goals tie into the SDG framework and the IFC investment principles, helping us to measure our impact on a global context. As the fund was only launched recently, these figures remain fairly low, but for every project we invest in, this is something that we project to see how we are likely to do when it comes to meeting our targets. What is particularly crucial is considering what would have happened in a base case scenario. If we had not invested, would this impact have occurred anyway? We want to see the extent to which change has occurred as a result of our work. These core outcomes go hand in hand with various impacts. As this occurs over the longer term and is less easy to measure, our targets for this are less clearly defined. But this is something we continue to monitor, and over the course of our investment horizon and beyond, we look at this particularly in the three categories: social, economic, and environmental development. And within this horizon, we consider impacts such as socio-economic development of local communities, strengthening human capital, areas with high biodiversity, and so on. So, that gives you an idea of the Forestry Fund, but we've also got the Microfinance Fund. Now, the Microfinance Fund has a clearly stated vision to contribute to the alleviation of poverty by supporting organisations that empower people and stimulate entrepreneurship, with a particular focus on the most excluded. The fund facilitates access to responsible finance by building sustainable links between investors, microfinance institutions, and ultimate beneficiaries. Our accompanying mission shows how this is done and notes the particular focus on the most excluded communities. Now, this is indeed a very worthy vision and mission, but how exactly can we be sure that we are reaching it? It's easy enough to measure the outputs, and this is something that we do very carefully. We're currently working with 50,000 micro-entrepreneurs in 26 countries. But although this gives you a starting point, as you can see, it certainly does not tell you the full story. I'm sure one of your first questions is about outreach. Are our microloans supporting those most in need? Again, this is all data which we, and other microfinance firms, spend a considerable time analysing. We look at the proportion of young people we support, the proportion living in rural areas, and the proportion of women, as these are often the most marginalised groups who suffer disproportionately from financial exclusion. But again, I hear you ask, what about outcomes and impact? This is where the analysis becomes much more complex. Every 2 years, we compile a very thorough report which looks at this. We ask our MFIs to provide us with as many metrics as possible, although this in itself is a dilemma. The extent to which MFIs should spend time and money gaining detailed impact data on, for instance, improvements in broad living conditions and the amount of time they should spend doing their core business is a very long and complex discussion. In this report, we look at underlying data on outreach in considerable granularity, and we also look at how our MFIs have progressed and grown. Where possible, we use case studies and demonstrate impact, and we're always very glad when a partner has had the chance to spend considerable time on the ground conducting an impact study. We're very pleased, for instance, when the EIB spent some time with PANF in the Ivory Coast and gained data on their contribution to financial inclusion and economic well-being. Another area which has been very important for our understanding of impact has been the aligners. This is a survey we conduct whenever we do due diligence, and which demonstrates how well social impact is integrated into the institution. Over time, we have been building up a database of results from these studies, and as it progresses, we'll be able to see how an institution improves on its processes over time, and perhaps even see how it evolves after technical assistance. So I hope this talk has covered a broad range of topics. We've looked at ESG and impact investment. We've looked at output, outcome, outreach, and impact. And we've also seen how this works in practice. Thanks again to Ada for giving us the chance to explain things from the perspective of impact investors.